Are we?
Bad.
Greetings.
We're
Hi,
thinking
everyone.
that we're blurry. We're hoping we're not. Maybe we're just
I'm a
drinking
little
too
blurry,
much.
but I can't focus from here because my number one, my glasses are foggy, and number two, I can't reach that far to the camera and focus. So, hi, I'm Bill Fairman, and this is Wendy Sweet and Jonathan Davis. We are with Carolina Capital Management, and welcome to what is our show? Don't say it.
It's on the screen.
Oh yeah, Passive Income Active Wealth Show.
That's right. That's good. You memorize that very well.
Nailed it, Bill.
Yeah, especially
Nailed
when
it.
it's written in front of me. So our website is carolinahardmoney.com. If you're a borrower, click on the Apply Now tab. If you're someone who's interested in some of that active
Passive
wealth
income.
with
Yeah.
passive income, don't interrupt me. I'm on a
Sorry.
roll.
Sorry.
Then
They just get there from two separate ends. Yeah.
click on the Investor tab. Don't forget to share, like, and subscribe to our show. We have tons of episodes on there. Tons.
And most of them are pretty good.
One or two
Some
of
are
them
mediocre. Yeah.
will help you out.
That's right. That's right.
So, you know what today is? It's Thursday, and it's
All day long.
Employment News Day. So,
So we have news.
yeah, we
I feel like
so
we're-
official.
Yeah, or like we're Jane Curtin and who was it that on Saturday Night Live? Jane Curtin. Jane, you.
and I don't think
It was
it
great.
was Chevy Chase.
Yeah, that was good.
So, this just in, Bill has a new sport coat.
That's right. And
Looking
he
fly,
looks
Bill.
handsome.
So,
And there's a fly on your head.
Oh, gosh.
continuing unemployment claims this week. We're actually down from last week by 9,000.
Yay.
I don't know what the number. I think we were in the 875,000 range last week, but they're down. So we're trending well, and
Good
the
news.
continuing unemployment claims are also down. I don't know what that exact number is. So my breaking news is not as sharp as it should be.
Yeah.
It's just getting better.
And it'll be down until
It starts going up.
until the airlines. Yeah.
Yeah,
That's right.
Yeah.
we were
was
talking
good.
about that. If the airlines don't get a buyout, there's going to be a lot of people that are going to get furloughed.
That's for sure.
I think probably in the 30 to 40,000 range.
Wow.
That's a lot. But you know what?
But will
It
that
costs a
last?
lot of money to keep these airlines rolling.
Yeah. I mean, will it last? I know they cut back the flights
Well, it will last as long as people are afraid to get out.
to travel. Yeah.
Mhm.
I mean, I've traveled twice in the past month.
Yeah, and there's nothing wrong with us.
and the first time I went, which is maybe 6 weeks ago, the airport was absolutely empty in the morning.
Yeah.
I like to fly the morning because that's usually the one that won't be late. And so I was surprised at how absolutely empty the airport was.
Well, with 2 flights now a day, they're usually not late.
That's right. But coming back, it was packed. It was in
Really?
the afternoon, and the airports were packed. All the eating places were open, and that kind of thing. Second time, I believe the same thing occurred. One was flying to Chicago, and the second one was flying down to Tampa. And I experienced the same thing at both. I also, on the Tampa flight, they had all the middle seats with people sitting in them,
Really?
which didn't occur on the first flight.
Yeah.
But now all
Well, it
the
depends on the airline. you
yeah,
fly.
U.S. Air puts people in the middle. Delta still has them blocked, I believe.
I like to fly in the afternoons because I don't care if the drinks are free. I'm not drinking in the morning. And if
At
it's
least
free,
he has
it's
his
for me.
standards.
He'll sleep all afternoon if he drinks
That's
in the morning. So.
He has his standards. I'm proud of
If
him.
it's
bud.
free, I'm going to take advantage.
That's,
So I just moved my schedule.
that's
back.
right. You know, there was something interesting that you said too a little earlier, though, when we were talking about unemployment. You said that the new jobs are not new job creations are not.
Mhm. Yeah, we have
stuff.
unemployment trending down, but new job creation is not trending up.
Which means
Which could be, we have, you have jobs that are going out of business and new jobs being created. It's not saying that there's not new jobs being created. It's just saying that the jobs that are being phased out or furloughed or being rid of are outpacing the new creation of
Yeah.
jobs.
Oh, well, that's a good way. That's a
Well,
good
that
way to
too,
look at it.
you could also look at it this way: as businesses are starting to reopen, they are bringing people back that were already there first. So some of those businesses that slowed down are starting to pick up. And some businesses are closing altogether and will never be back. But
it's a strange time. I mean, you have some businesses that are just booming and exploding and hiring like crazy,
yeah,
and you have others shuttering their doors. I mean, it's
It's
sad, but I
strange.
mean, I'm happy for the ones that are, providing a service during this time, and that's valuable and reshaping kind of our economy a little bit, and pivoting where they need to pivot. I mean, I saw where hotels. I mean, they're renting out rooms to companies, for offices. They're renting, they're putting homeless people in there. They're doing all kinds of things just to make it through this. So
Right.
it forces innovation.
what shocks me are the small restaurants that never had a website, and still don't think they need one.
Yeah.
Where you're having fewer and fewer people that are going to the restaurant for dinner, but they still like their food,
Right.
and they don't want to have to call them up and say, "Well, what do you sell?"
Right.
Because they don't have a website that has a copy of a menu on it,
Right.
or they don't have a phone app. Which, by the way, you can get a phone app built for your company for next to nothing.
That on Fiverr.com. $5.
And you don't have to have
that's true.
you don't have to have a fancy phone app that takes your payment, sends the order in. You can have a phone app that at least shows the menu, and then you just hit a button to call them and say, "Yeah, I'd like this."
Right. Right.
I just don't get it. These people are complaining about not having any business. You have to innovate. If you don't innovate,
Yeah.
or you have to go with how the people want to be served,
Right.
you're going to be left behind.
Here's what I thought was funny. I went to a birthday party of a dear friend last night, Jeff Johnson, and it was held at this old mill house that's been converted into, it looks like a big giant food court. That's really what's there. It's got in the center, it's an open courtyard. It's all outside. Really, really, really nice place. But on the inside, it's a U-shaped building, and it's just little restaurant after restaurant after restaurant. You don't eat in the restaurant. You take it either outside or there are little chairs in the hallway. It looks like a gigantic food court. And the restaurants that are serving are really, really good. I mean, it was amazing, the variety and everything. So when you walked inside to get your order, if you didn't have a mask on, they would stand there in front. Now they've got plexiglass in front of their stations, and they have masks on.
Yeah.
And you're standing 6 feet back. They will not take your order standing in front of them. They'll say you have to use your phone app to order.
Because they don't want you to speak into
They don't want you, but they've got, an armory in front of them. It was really interesting how different it is in North Carolina versus
They
what's
have to
going
do
on
that
in
to
South
stay
Carolina.
open.
Yeah, that's for sure. But everybody's out in the food court sitting, right next door to each other. I'm pretty sure that spit travels in the same kind of air outside that it does on the inside. It's so weird, the regulations, how different it is and how it just doesn't make sense.
Yeah, I mean, it's different. I mean, you go into a grocery store and you
touching all the cans.
Touching all the cans. I mean, I went to go get my haircut yesterday. They wouldn't let me touch anything in the
which looks nice, by the way. You don't look like a hippie anymore.
What do you call it? I guess it's not really a barber shop, but whatever it is. I couldn't touch anything until they watched me sanitize my hands.
And they got your temperature.
And they took my temperature. But yeah, I mean, everywhere is a little bit different. We're all just, everyone's trying to take precaution and everyone's trying to feel safe, and whatever you need to feel safe is relevant.
Yeah,
we're a very litigious society, so
they were
part of these things that they're doing has nothing to do with CDC guidelines or regulations that the states have put out, but they're
Right.
more worried about litigation and liability.
Which is
Yep.
For
sad.
somebody saying, "Oh well, I got COVID and I'm sure I got it in your restaurant,"
Yeah.
because
Yeah.
they know exactly when it happened.
Yeah. Yeah. It's
But
all really
I mean,
sad.
you're a target as a business. You're a target, no matter what.
Yeah.
And
And it's hit home for you and I. We just
We-
lost a cousin
Yep.
to COVID, and our family is
yeah, we're
absolutely
not taking
devastated.
it. We're not taking it lightly.
No.
Don't get me wrong, but you still have to live your life. You just do the best you can to take common sense precautions. That's all.
Mhm.
Okay, so
And not shame others. Whatever
Yeah,
they think is,
yeah.
that's the biggest thing. People shaming other people on both
Whether
sides.
you're wearing it or
Oh
not
yeah,
wearing
it's
it.
like
Yeah.
there's no need for that.
Yeah.
There's no need for that.
Yeah. It's just a divided society right now.
Yeah. But let's jump into our
Questions.
ugly
we
questions.
have a question. Today's
means
ugly
it's
question is
serious.
in 72 parts. Actually, it's not.
It's
We just have 72
two
answers.
That's right. That's right. It's in fact so many answers.
Why don't you tell us what the question?
There's so many answers that we knew it would pretty much take the full time to talk about it. So our question is, what questions should you be asking when you are shopping for a hard money or a private loan? And that is, I think it's a great question. I get that question all the time.
I feel like everyone's first question, especially new borrowers, is what's your rate?
Mm-hmm.
What's the rate? How much am I going to have to pay? What's the rate? And while that is a valid question, on
It's
my list,
one of the least
it's probably one of the least important.
Coming from a hard money, they're saying, "Yeah, you're a hard money lender." Of course, you're saying that.
I borrow money as well, and I do real estate deals personally. And again, on my personal list, interest rate is pretty far down the list.
Right.
Interest rate is very important on a long-term cash flowing
Correct.
property.
Yep.
Mm-hmm.
Because that's going to determine how much cash is flowing.
Well said.
But when you're doing a value add project, that's not. It shouldn't be an issue.
When you do a value add project, fix and flip, repositioning, whatever it is, the first question that should come to your mind is leverage. What is the leverage? So, what is my equity stake versus the interest rate? So that should be, in my mind, that's the first question.
In third grade is how much money are you going to have in it?
Correct. How much money do you have to bring? How much equity do you have to provide? How much skin do you have in the game? Because in a repositioning, like a fix and flip or a multifamily repositioning loan, it's the acquisition. That's what you're after. The acquisition. You made your money on the acquisition.
Right.
On a long-term cash flowing project, you don't necessarily make your money on the acquisition. It requires, like Bill said, to be able to cash flow. So, paying 12% as opposed to 4% makes a big difference on cash flow.
Absolutely.
So, yeah, on long-term stuff is a big deal. But when we're talking, so for the sake of argument, for what we're talking about is all pretty much 18-month less loans, which will all be short-term loans.
Right. So that first question should be, how much money am I going to bring to the table? That's really what your concern is what is it that I'm going to bring out of my pocket?
Yeah.
And what adds up is, if you have to bring a down payment on the purchase price or a down payment on the rehab amount, because some companies do that as well.
Mm-hmm.
So that's money you're bringing out of your pocket, plus closing costs. Are you bringing closing costs out of your pocket? There are some lenders that will roll the closing costs into the loan.
Yeah.
And you don't have to bring that either.
Yeah.
So there are companies out there that will put you in your position without you bringing a dime to the table. I couldn't tell you which one does, but I know there are private money people out there that do it. And I've heard that there are companies out there that do that.
Yeah.
And I really don't know the name of one, or I would share it with you. I promise I would.
And I had a conversation with a commercial potential borrower, I think last week, and he brought to my attention, he's like, well, I have 2 other offers from other lenders at 8%. I'm like, okay, cool. And I said, well, what's your down payment? Well, it's between 25 and 30%. It's like, Okay. So 8% and 30% down, as opposed to, let's say, 10% and 10 or 15% down. Like, I'm not going to do the math for you, but do it over the life of the loan, a 12-month loan, and see which one you have less money in.
Right. It's pretty obvious.
Yeah.
For sure.
See, the one thing that you always have to keep in mind is the cost of the opportunity lost.
Mm.
So if you're putting a lot more money down, that means that's money that you could possibly have working somewhere else, and you're going to miss out on that opportunity.
Mhm.
Secondly, peace of mind. If you have that extra cash in the bank and things go wrong, which it's real estate, things go wrong.
Yes, they do.
They're always going to go wrong. If they don't go wrong, that's the cherry on the top.
That's right.
Yeah.
That said,
Then you're Superman.
you have a lot more ways to get out of a predicament if you have money in your pocket,
Mhm.
not being held with somebody else.
That's
Well,
right.
I mean, and again, another conversation I had with the commercial borrowers, they could go straight into CMBS loan at 4 or 5%.
CMBS line.
So a commercial mortgage loan. So
Thank you.
yeah, they can go straight into that. It's commercial mortgage-backed security, but they don't take that on the acquisition. They take a much higher rate. And why do they do that? Because they have to bring less money to the table. And if they were here, they would tell you, well, I do that because I'm a savvy real estate investor. If I have to bring less money down, the difference of that 4%, let's just say 11%, that 7% difference. He's like, as a real estate investor, if I can't make at least 7% on the money that I have, then I'm not a good real estate investor. He's like, of course I can do that. So I'd rather have more money and I can make more than 7% on it. So I haven't lost anything.
Well, it's not just that too, it's speed.
Yeah.
You're paying for the speed of the transaction to close, and the faster you can get a transaction to close, the more likely you are to get the deal in the first place.
Mhm.
Yep.
Because as a seller isn't going to take a property off the market, and by the way, most of the people that we deal with aren't buying stuff on the market.
Yeah.
But that said, there's other people that are interested always,
Right.
because there's plenty of competition out there looking at the off-market properties as well. I
Right.
guarantee you, if they called you from a mailer, they've gotten 12.
Oh yeah, absolutely.
Well, and the other thing is, like, you don't need to, I guess, what's the best way to say this? Your rate versus your leverage. Like, if rate is the most important thing to you, then you're swallowing a lie,
Mm-hmm.
because rate doesn't matter. If the difference between 8% and 10%, a 2% interest only payment, kills
that
your
much.
deal,
Mhm.
it's not a good deal. Your margins are way too thin.
Mhm.
I think personally, like, when I do properties, even on a fixed to rent, if the property doesn't cash flow at 10% interest, I won't do it.
Right. That's a good
I
point.
won't do it, because it has to make sense, even if I can't exit that, which was a great strategy given COVID, because I had to stay in some deals a lot longer than
Yeah, that's for
I
sure.
planned on it.
That's for sure.
One of the things, and we don't have this in our answers on or a question, I'm going to add this. You need to find out if there's a prepayment penalty,
Oh yeah,
Mhm.
we should add that.
because one of the things I always tell people, and I know if you guys have listened to us before, you've heard it from us before. If you have a 12% interest rate, it's annualized. It's based on 12 monthly payments, and if you only make 6 monthly payments, you're really only paying 6%,
That's right.
because you're paying it half the time. And if you use that strategy and you go in and say, I don't care about the rate because I'm going to pay it off in half the time,
Yep.
and you find out there's a prepayment penalty on it
Then you're
because
up the
you didn't
creek.
ask,
Yeah, then you're up the creek.
then that strategy doesn't mean squat.
That's for sure.
Now you're concerned with interest rate.
Yeah.
Well, that's true. And then,
But most of us in this industry, unless you're doing bigger commercial actual property,
There isn't a
you're
prepay.
not going to see a prepayment.
now, just be careful, because there's a lot of lenders who don't word it as prepayment, but they word it as 6-month interest earned. So
Yeah,
you
very
have,
good. Say that again. Say
so,
that again.
So like they'll word it as 6-month interest earned, or 6 months of interest is due for this loan no matter what.
Yeah.
So
That's
that
a
is
prepayment
a
penalty.
prepayment penalty, because if you pay off in 3 months, you're still paying 6 months of interest.
Yeah,
So,
I just did one myself where I'm the borrower. And I know it's going to be a really short term because this is a house that I'm basically going to clean up and throw on MLS real quick. So I know it's not even going to last, 3 months maybe. So the loan is set up for 6 months, but I guaranteed 3 months worth of payments.
Yeah.
Because I wanted to make sure that it's worth their while to wire the money and
you get a loan from them
done.
again.
That's right.
Yeah.
That's exactly right.
Yeah.
So here's another one. What happens that you need to understand what that term is and what happens if I go past my term.
Yeah.
So for us, we usually do a 6-month term for quick fix and flips. For new construction, we go up to 12 months. Sometimes if the rehab is over $50,000 or even sitting at like $100,000 on the rehab, we'll tend to set it up at a 9-month term because we know it's going to take a little bit longer than that. But you need to know what that term is, because you don't want to get to a point where you're at the end of your term and you're not done. What are you going to do then? And that leads us to our next question: is what happens if I go past my term? Can I renew it? And renewal is kind of different for
everyone,
for everybody.
Some people put it in the notes as a option. Most will put it in as a lender's sole discretion, and that means that you as the borrower, you can request it via written request, and the lender has X amount of time to review it, and assuming the market conditions are favorable to what they want, you've made all your payments, you've been a good borrower, they'll probably say yes.
Yes, and there's a fee for it.
And usually there's a fee associated with it.
And the reason there's a fee with it is because our goal is to turn our money in the fund at least twice in 1 year.
What's the cost of lost opportunity?
Right.
That money was supposed to come back at X time. It didn't. And if that money did come back at X time, it could be recycled and make X amount of money. It didn't. So there has to be some kind of fee to offset that loss of potential income.
That's right. And if we're really living off our points, which is really what we're living off of, is the origination fee. That's really where a company makes their money. A smart company makes their money anyway off of that.
I was going to mention, if you're a private lender, you can use something. If you're a private lender and you're loaning money and you're worried about a term being a little bit longer than you'd like it to be, or your borrower says, I need this money for a long period, and then you're worried that you don't want to get locked into a long-term situation, you could put what's called a call option after a certain period of time.
Correct.
It's not a balloon, it's a call option. And what this does is it allows the lender to call the note due, to renegotiate the note, or to leave it the way it is.
Yeah.
And that way, as a lender, you feel good knowing that you can still continue to get, we'll call it market returns. And if the borrower is chronic slow payer, you can call the note due and move on to another one.
That's right.
And at the same time, your borrower has at least the idea that they could probably continue doing this as long as they're keeping up their end of the bargain for a lot longer.
That's good.
I will make one point, because one thing that has irked me here recently is IRA companies asking for like signed extensions or modifications of loans. One, they're an IRA company, they're a custodian, they're not a servicer. That's a whole separate issue. But don't get me too started.
And it's really just a request. They're not. They
have
can't require
no power.
you to do that.
Yeah,
and it's already in the note.
I know. So anyway, we're talking with these people. It's like people, I think, maybe don't realize this. There's nothing wrong with a matured loan. Like holding on to a matured loan, there's nothing wrong with it. It gives the lender, if let's say you're a one-off lender or you're doing it out of your IRA, it gives you all the power, because accepting payments post-maturity does not deteriorate your loan or your ability to effectuate any clause in the deed of trust or mortgage.
Right.
You can accept payments for as long as you want. But if you throw an extension on there, or an extension, or a forbearance or modification, it pushes that maturity date out. Now you are you're locked into that loan again for that time period. So just as a lender, there's probably not too much wrong with the matured loan. That's just my little 2 cents here and kind of a little aside.
Right.
It's been irking me. It's IRA companies, man, killing me.
But they're good. We
Well,
love
our
IRA
longtime
companies.
listener or viewer, Scott, has asked the
This
question.
is on our list already. What happens if I can't pay? That's on here.
Well, if you can't pay because it's mature.
Well, that's still on here. That's still on here. So we'll skip ahead and go to that because I really just wanted to have a bunch of questions set up for people.
Mhm.
So what if I can't pay? And there's a couple of things that you can't pay. You may not be able to pay not only the pay off, but you may not be able to pay for things that aren't on your budget. So that's a question that's really kind of in here twice. So what happens if you can't pay? Well, that leads us to many other things, doesn't it?
There's a lot of things.
So as for us as a hard money lender, if you can't pay, we want to try to work with you. We want to try to help you sell the house, get it to another investor, maybe set things up, change the payments a little bit to get you to a point where you can finish it up and move on. So it really depends on where you are in the deal, right?
Yeah, and one of the he's a one-off borrower of or one-off lender of ours, Bill Mann, and what he does in a lot of his loans is someone matures and they can't pay it off. He requires them to pay 10% of the principal down, and it'll go out for X period of time. If they still can't pay it off, you have to pay 10% more, which is just lowering his liability on the loan as it goes. So there's that option. There's extending it out. There's working with them. There's obviously foreclosure,
which is a last straw for all.
Should be.
Yeah, hard money lenders and private lenders. We don't want your house.
If you're a private lender or an institutional one, it doesn't matter. You just have more leeway as a private lender. You can do what the heck you want.
Right.
Scott's specific question had to do with if it's a call option and the loan is called,
right,
and you can't pay. How do you, what do you do? Well, if you're calling the note due, there's a reason. You either have to. You need the money as the lender to do something else with. An emergency could have come up. You don't know. But there's options for the lender as well.
They can
if
sell
they
the
can't
note.
pay, they can sell the note.
Mm-hmm.
And as long as you had a good, mortgage history on it, that the borrower's been paying on time, someone that's buying the note would be happy to buy it.
That's exactly right.
Now, if the current interest rate is well below what somebody's willing to buy it for,
right,
you may have to discount it, but you can always settle with the borrower and say, look, I realize you can't pay this amount, but if you'll pay me this, I can sell this note to somebody that's willing to take it off my hands.
So they can,
and then you can continue to pay that payment.
That's good.
Yeah.
But you're going to have to pay this amount down for me to do it.
Who do you sell it to? He asked again, and it's you can sell it to someone with a self-directed IRA. You can sell it. There's a whole host of companies and people who would buy.
You can Google note buyers.
Yeah.
And you'll have a list of different
Eddie
entities.
Speed would be a good person to talk to. Talk to Eddie Speed. You're like,
or his wife Martha. She buys notes like crazy.
Martha would be a great one too.
Yeah. Yeah. So there's a lot out there of note buyers that are out there that you have access to. So the next one says how many, we talked about how many times can I renew? Well, that's one of the things that we talked about could be at the discretion. That's in our note, that it's at the discretion of the lender.
I'll give you the attorney answer.
Yeah, it depends. That's a good one. That's a good one. The next question that you need to be asking is, are payments monthly or are they paid at the end? There are some companies out there that will allow you to take a loan out and will not charge you interest during the life of the loan. They want it paid at the payoff.
Well, they are charging interest.
It's accruing.
They're
They won't make you
They're
pay
just
it
not making you
on
pay
a monthly
payments.
basis. They accept it at the end.
Yeah. There's others that will build in a payment escrow on the front end too.
Yeah, and
Yeah.
collect it at the closing,
Mm-hmm.
which means you're going to bring more money out of your pocket to the table because you're really prepaying your payments. We collect it monthly. People who are collecting it at the end, that's more likely going to be a private money lender that's going to do something like that.
Tell them why.
Because they don't know any better.
Tell them why you want them to make monthly payments.
Feel the pain.
Yeah, I want
There
to
you
light
go.
a fire under their butt and feel the pain of writing that check.
If
every
you make
month.
0 payments for 6 months and some things are not going the way you want them to, how incentivized are you to pay off? Probably less than if you had made 6 months of payments and that came out of your pocket.
Yeah, and you're thinking about it.
Yeah.
You're thinking about it every month. I need to be in a hurry to make this happen. It's not because we're into torture, or we want to make people feel bad.
We're into getting our money back and not having
And
properties.
we want you to be successful.
It's in your best interest.
That's right. That's
To
exactly
get this
right.
thing done quickly.
Yep.
You must always in your mind. You want to move quickly.
You want to have a sense of urgency.
That's
in
what
you're
I was
doing.
going for.
And I know you were
I
trying to get there.
couldn't figure out the word. Anyway,
Throws out litigious, but he can't get urgency.
That was too easy.
I'm multifaceted.
That's for sure.
However, again, it's in your best interest. The quicker you pay this thing off, the more money you're going to make, right?
Yeah.
And then we've always had these, not always, we've had people along the way that will step over a dime to pick up a nickel.
I know.
I've got this certain price in mind for sale of this house, but you've offered me this, and I'm not going to take it, even though it may take me another 90 days to sell it, and I would have lost that in payments. So no, move it along.
Yeah, those can be just
Bird in
Take the
hand.
money
drive
and
me
move
nuts.
along.
Bird in the hand. Bird in the hand.
$250,000 today is worth more than $280,000 90 days from now. Every time.
That's the
Every
truth.
time.
That is the truth. What kind of insurance do I need?
Life.
That's
Depends on the project.
That's right. That's right. So for basically a 1 to 4 family type unit, and it's not livable, you're usually getting a builder's risk policy. Builder's risk, it really covers, it covers a lot of things that a vacant policy would, but builder's risk will cover theft for
Materials.
your materials, like they're dropping the shingles in the yard and all of a sudden they're gone the next day. And
It
trust
doesn't
me, that
cover
happens.
tools,
Yeah,
just materials.
yeah, your contractor has to be responsible for their own.
I thought you say your contractor doesn't need to be a tool.
That too, that too. But that's what builder's risk is for. And really, they only really want you to get builder's risk if you have, if the rehab is, I think it's 30% or more of
I thought
the
it was
price of the
50,
house. No, it's 30.
Okay.
So if it's, a lipstick on a pig, you probably don't need
Just
builder's risk.
Yeah, you just get if you're not moving
Just get a
walls, you're not
vacant
doing,
policy.
construction, you can probably get a vacant policy.
Yeah.
Vacant landlord.
Yeah, but talk to your insurance person about that and what it covers, and it doesn't hurt to ask those questions for that person. So, what happens if I go over my budget?
You will.
Oh, by the way, before we get to that, we don't require this, but you should have a blanket liability policy as well. We don't
You mean
care
as a
about
company?
Yeah, as the owner of the property, you should have a blanket liability in case someone gets hurt on your property, because it is your property. Your name is on it. We don't require it because as a lender, we're not going to get sued if somebody trips and falls across the stuff your builder left down there in the yard that they were trying to steal.
Is that a blanket liability or an umbrella?
Blanket, umbrella, whatever.
Okay.
You just need a liability policy that covers everything other than structure,
Yeah.
fire.
Yeah.
Go ahead. I'm sorry.
I forget where I was. What happens if I go over my budget?
Yeah.
Is that where we were?
We said you will.
Yeah. You will. In fact, it's all, I'd say 90% of the time you're going to go over your
You're
budget.
going to find something.
Yeah.
Every time. Once you can walk through a house, a building, all you want. Until you open up those walls, assuming you're moving walls or
Mhm.
doing something, until you open them up, you don't know the full scope of what's going to happen.
Right. That's exactly right. And if it's not on your rehab budget, your lender is not going to cover it. So you need to make sure. So what happens if that means you need to have money in the bank to cover that issue? That's why we care about how much money you have in the bank. So you can't get a loan and have $3,000 in the bank. It's just not gonna. It's not smart for you.
Yeah, I mean, because lenders are holding a certain LTV, loan to value threshold, and just because you find an issue in the walls that we didn't know was there and it costs more money, doesn't increase when we fix it. Doesn't increase the value of the overall product.
Right.
It's the same value, so that money has to come from somewhere, and it's not the lender. It's going to be from you.
And I promise you, if you're in 3 deals at one time and you are doing fine, everything's running normally, you had enough money to do each one of the properties, something will go wrong on all 3 of them at the same time.
Yeah.
It will happen, right?
I mean, I bought 6 properties in Gastonia, and all in the same street, and go in, and now I have 5. I have to tear one down. Like,
Oh,
and I
wow.
did. I mean, luckily, the margins still work. I mean, they're a lot thinner than they were, but I mean, yeah, I lost a whole house. So like those things happen.
Yeah. I hate when that happens.
Yeah,
But
you
it
lose a whole
does.
house. Yeah.
But it does. It happens. It happens to people who
That's
know
your inspector's fault.
it happens to people that know what they're doing.
By the way, you should automatically build 10 to 15% contingency into all your budgets.
Yeah, that's for sure. That's for sure. Okay. So, what happens if the work needed is not on the budget? That's really what we're talking about is if it's not written into your budget, that's something that's going to come out of your pocket. You can't expect that to come out of the lender's pocket because the lender doesn't want to be any deeper into that house than they started out with.
Yeah.
So if they give you money to cover what's not in the budget, that means that they're not 65% in the deal or 70% of the deal. They're now over the percentage of the deal, which puts them at a greater risk.
Spend the few $100s more that it would cost you to have a home inspector come in and go through the house before you put a budget together.
It's so
Ignore
worth
the
it.
stuff.
It's a couple $100.
Yeah, ignore the stuff that you know you're going to be repairing, but stuff will come out. And if the inspector sees it when they're inspecting your house, they're going to see it when your buyer has it inspected.
Exactly.
Yeah, I'd rather know up front. So, do I pay interest on the full amount of the loan? That's a great question to ask. There are a lot of regular construction loans that you get from a bank. A bank will only charge you interest on the money that you're using. That's very, very normal. That's not normal in a hard money loan or a private money loan. We have to earmark that money for you. It's because when you come to us and say, hey, I need my $25,000 to do this repair, and we go, oh, we lent that money out to somebody else, or oh, I'm out of money. That doesn't work. So we have to have that money available for you, and especially the smaller private money lender, that really affects them because they're very limited on the funds that they have. So you're going to have to pay interest on the money because they can't lend it out to anybody else. Now, there are some companies, some hard money companies out there that will only charge you for the amount of money that you're using. There's some out there. Again, I don't know who they are.
Yeah.
I'm not trying to keep it secret, but I don't know who they are. If I do, I'd tell you, but there are companies that do that. So if that's important to you, ask that question.
Yeah. I mean, it's called Dutch and non-Dutch. Dutch is interest on the whole balance. Non-Dutch is interest on what you're using. In the hard money, private money space, even the kind of that quasi-institutional hard money space, the only time, well, not the only time, but the times that I most likely see non-Dutch is on larger commercial deals with, hundreds of thousands to multi-million-dollar rehab budgets or construction budgets. That's the only, if you have a $50,000 rehab budget on a fix and flip, I don't know anyone who's going to say we're not going to charge you interest on that.
Yeah,
Like,
it's
I mean,
kind of crazy.
Oh, before we get to the next question, and by the way, we are on the Ask an Ugly Question segment, and our question is, what questions should you ask when you're shopping for a hard money or a private loan? We are Carolina Capital Management. Our website is carolinahardmoney.com. If you're a borrower interested in borrowing money from us, click on the Apply Now button. If you're an investor looking for passive returns, click on the Investor tab. Don't forget to like, share, and subscribe to our channel. And if you have any questions, you can go over to the chat box, either to the right or to the bottom of your screen, depending on the platform that you're watching, and you can ask
That's
us
right.
questions
Let's look
as
at the
well.
time. Okay, we got about 15 minutes to finish up. So
wow.
the next question is, do you use an appraisal or a BPO, which is a broker's price opinion, or they may just pull their own comps? Do you use an appraisal or not?
Mhm.
We all lend money based off of what the after repaired value is. We use a full appraisal. I would love to know exactly what every house would sell for. I've had my real estate license, thanks to my mother, since 1981. So I've got MLS in both states, both North and South Carolina, and I took the appraisal course, and I'm still wrong when I
Yeah.
come up with prices. I can give you kind of a ballpark, but I've been just wrong, 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 wrong.
Well, it's hard to, I mean, again, appraisals are using past data to predict now and future values. That's a difficult task
It
to
is.
undertake. I
It
mean,
really is.
because now, I mean, we all know real estate is so local. I mean, a street, a neighborhood, a borough, whatever it is, I mean, it could be trending up or it could be stagnant or it could be trending down. And, at that point in time, the prior data says trending up. The current data says it's trending down. So 6 months from now, that house could still be trending down. So you get an appraisal at 300,000, but you might only be able to sell it for 260.
Right.
Like it's not a complete science. There's a lot of just using the data.
Opinion.
Yeah, a lot of opinion and a lot of using the data that's
Yeah.
at hand, but the data's old.
Yeah. And and that information is in an appraisal. There's so much more in an appraisal than you'll know from any kind of a BPO or pulling your own comps. What's going on in the neighborhood. Is this a house that's going to qualify easily to whoever your end buyer is going to be?
Yeah.
And an appraisal can help you qualify that house a whole lot better than just a broker's price opinion on that. So
Very true.
we use an appraisal. It's worth asking that question. The other thing is, do you have a loan minimum? There are many, many companies that don't have a loan minimum, or if they do have one, it's pretty low. Ours is at 50,000. And there are companies that have 75,000, companies that have 100,000,
Yeah.
and even in the millions when you get up into
Most
the
of them do have a
commercial.
minimum.
Yeah. So why is there a minimum? It's because when you are doing the loan, everything's based off the percentage of the loan amount. Well, if the percentage is really, really small, you're doing all of the same work for itty bitty amounts of money.
Yep.
So what we do have a loan minimum. We'll go lower than our minimum, but you're going to pay as if
The 50,000.
it's at the 50,000.
We talked about this last week. Return on effort.
Mm-hmm. Mm-hmm.
Yeah, we have to work as hard on a $50,000 loan as we do a 200,000.
It's the same amount of work.
That's
$1
right.
million to 1,000.
But the other thing I think that's really important is if you don't meet the minimum amount of the hard money lender or the private money lender, you need to be concerned about your exit strategy out of that loan once you get into one anyway.
Yeah.
Because banks have loan minimums.
Mm-hmm.
And if you can't get out of the loan, you're in deep doo-doo, right?
Yeah, keep in mind, a traditional bank that's doing a mortgage loan for somebody that's going to buy this home from you is not going to go typically below $80,000.
Yeah.
Because what happens is there's a certain amount of fixed fees that are a percentage of the loan, and the fees remain the same no matter how big the loan
So you'll
is.
take the ARP
And as
out.
the loan goes down in size, what it does is it hikes up the fees that go into the APR, and then that puts them into what's called a high cost mortgage.
Mm-hmm. And they
And
get
then
in trouble.
they have to go, thanks to Dodd-Frank, they have to go through a whole lot of hoops, and
Mhm.
they don't want to bother with it. So they'll just say, no, we don't do high cost loans.
Right. Right.
Yep.
Right. So ask that question. So, and if that question is that there's a loan minimum and you're not able to make it, you might want to question whether or not that's really a house that you want to do because of that. What does your draw schedule look like? That's really, really important when you're doing a rehab. How many draws can you have? Do you have a maximum of number of draws that you can have?
What do you charge for your draws?
Yeah, that's another one. And I
Yeah.
didn't have that on there. That's a good one because there is a fee when you get a draw. There's people that have to go out there and look at the house and make sure that the work's been done and what is left to do. You know, do I have enough money in this account to finish up the work that's left to do?
Yeah.
So ask about that draw schedule, what it looks like. Another thing is, do you need the receipts? I get a lot of people thinking that they're going to have to turn in the receipts of the work that's done, invoices and things like that. We don't care to look at them. There may be some companies out there that do want to see.
Well, if
receipts.
we pay the third party vendors directly, we do want those.
Absolutely.
Yes.
So that we know what to pay them.
Yeah. But that's why the rehab budget is and the scope of work is so important.
Mhm.
That we have an inspector that goes out there and compares the scope of work rehab budget to what's done and what was said was done, and then we can say, okay, yeah, 80% of that was done or 100% of it was done, whatever that case may be.
Right. Which leads us to the next question that you really just brought up is, can I pay my contractor? Can you pay my contractor direct?
We'd love to.
Yes. Yes, absolutely. The next thing is, do I need lien waivers?
Yes.
Please. They're so important, right?
Oh man.
I can't tell you how
You
many
cannot sell the house if there are active M&M liens on the title.
M&M is not a candy.
It's materials and mechanics lien.
Mhm.
You cannot sell it. It'll cloud title. You'll have to get those cleared. So, any savvy lender or any savvy person in general wants to make sure that if we're putting money into the property for the draws, we want to make sure that the money that we're putting in for the work that was done is being paid to those that third party, those contractors. And for that, they will give us a lien waiver saying, hey, we are paid in full and we do not claim any lien on this property.
Right.
So that's
Right.
what we want to do there. That's what, as a borrower, you should want that too. As the owner of the property, you want to make sure you're collecting those.
So even if your lender doesn't require it, you should be getting it yourself.
Yep.
And so when you have that check in your hand ready to pay this person, you have a lien waiver right beside it.
Yep.
And have a copy of the invoice that you're paying attached to it with maybe the invoice number and the price on it written on the waiver. Let them sign it, give them their check, and then you've got what you need to say they've been paid in full.
Yeah, because we've seen it before. You do a project, you pay the contractor, and you think all is good. You go to close, and there's still a lien on it.
Right.
And the contractor, some less scrupulous than others, they'll
There's
say
one or two out
yeah,
there.
they're like, well, I need $10,000 to get that off. You owe me. And here's the thing: depending on which state you're in, if the contractor can prove that he did work within a certain period of time, it's valid.
That's exactly right. It's 6 months in one of these
Okay,
states. I don't know
so
which
we've
one.
got 4 minutes and 4 questions. So
Okay,
speed
so
round.
we'll do it quick. Do you need a clear title close?
Yes.
You don't want somebody coming back and taking it from you. How many loans can I do with you? Ask your lender that. How many loans can I do at one time? That's a great question.
It depends.
The other one is, do you drop rates or points as we build a relationship? That's a great question. That's a great question.
And then, do you do equity participation?
Yeah, I love that. You want to talk a little bit about what an equity participation would look like, Jonathan?
Sure. Say you're one of those people who want a really low rate, and you're like, man, I just can't pay more than 8%. Just can't do it. Okay. Well, you're going to have to bring 30% down. Well, I don't have 30% down. Okay. So we can give you or lend you X percentage of that 30% as an equity participation, maybe mezzanine debt, which is it could be equity or it could be like second lien position. What, it kind of, depending on who it is, mezzanine means different things. And we can lend that to you, which allows you to do the deal, still
in
bring
the upper deck.
still bring less money, have a lower rate.
Mhm.
However, for all of those things, you have now given up X percentage of the
Profit.
profit of the equity when you sell it
Mhm.
or you refinance it.
Mhm.
And that depends on the lender, and that depends on the structure of the deal. But I typically see it.
We
Seen
do
it.
them with commercial deals.
Yeah, I've seen
all
them
the
as
time.
low as
Yeah.
5%, and I've seen them as high as 80%. So it just,
which is nice.
And I can guarantee you, if your margins are thin, you're not getting any equity participation.
Yeah.
Yeah.
Because there's no guarantee that the person that's going to do that is going to have any profit when they're done.
That's
Yeah.
right. So these list of questions, I am going to put these up on our website
good.
so that you can just get right to the list and have that in front of you. So if you go to Carolina Capital Management, no, CarolinaHardMoney.com, and we'll have a button there that you'll be able to find that.
I think if you go over
passive
to
wealth, right?
Yeah.
go over to click on the resources tab. We'll
Yeah,
have it
that's a
in
good
there.
place to put it. It'll be under there, and it'll be called questions you should ask when shopping for a loan.
Right. And we're also going to, and I think we told you this last week, we're going to do some articles comparing different lenders, different funds,
Mhm.
The best practices, that type of thing. One doesn't mean they're better than another. All it means is, are they the better fit for you?
For you, for that, and even
Right.
that particular deal.
Yeah, absolutely.
And Sue, if you're on, I see you calling. I'll call you back in a little bit.
She's calling to say, I like your haircut.
Yeah.
I think she's calling to me about an IRA question.
Anyway, I hope that answered most of your questions about what questions to ask when you're looking to get a loan, right?
Mhm. Yeah.
So once again, we are Carolina Capital Management. We do lend money. So if you're a borrower looking to borrow money, then click on the Apply Now tab. If you're an investor looking for passive returns, click on the Investor tab, CarolinaHardMoney.com. Don't forget to share, like, subscribe, all that good stuff. And we will see you guys next week at this very same time.
Remember, rates don't matter. Leverage and speed.
That's right.
Take care.